Well, hello everyone, and good afternoon or good morning, depending on which coast you are on. My name's Heather Shepperly. Welcome to McQueen Financials ALM 301. Today, we're going to dive a little bit further into our educational series on asset liability management. And again, my name is Heather Shepperly. I'm the VP and Director of ALM here at McQueen Financial. I've been doing this a very long time and seen some interesting things over the years. And joining me is Bill Verrett, who has also had a significant amount of experience in our world. Thanks for joining me today, Bill.
Thanks, Heather. Yes, a lot of experience, but I don't want to date my age. So let's just say very experienced.
We'll keep that at bay.
Yeah.
We're old enough to know and have seen rate cycles, so we definitely have some great conversations today on looking at ALM and how we're going to leverage this information for decision making as we get into budget season. So definitely some great conversations we got coming your way, and just a little housekeeping before we dive into our webinar. As you have questions throughout, we have a little icon at the bottom, which is our Q&A. Please feel free to enter those questions as they arise. We have a lot of great info going on today, but if there's anything we haven't answered at the end of the webinar, we're going to go ahead and open those questions up and start answering them for you to get that information back. We are also recording today's webinar. That is going to be available to everyone on our YouTube channel once that is wrapped up. Usually is available by the next day, but that will be available to you on that McQueen Financial YouTube channel as well. And in the meantime, any questions that you may have, never hesitate to reach out to your advisors. They're always available to you as well. So a little overview of what today's webinar is going to entail. We're going to do a little recap. We know that we are doing an educational series, and with that educational series, we want to recap a few of those items that we had discussed in our 101 and our 201 that we did earlier in the year. So we're going to recap a little of our 101, which was our introduction to the concept of ALM, our 201, which gets into the assumptions that go in. We joke a lot that ALM is a little bit of science and a little bit of art, and that science side is the accounting, getting the numbers right so we can understand the structure of our balance sheet. And then the second side, which is that art side or that finance side, where we're implementing assumptions that drive some of the testing and the output that we see. So now the third layer is our 301. Now that we've established the foundation of what our risk position may look like, how do we use this information for planning for next year? We're getting into budgeting season here in these coming months, and we want to know what to be prepared for. The nice part is we are exposed to a lot of these things that are going on in the market, and some of the three kind of main focus points we're seeing for most financial institutions is ongoing concerns on liquidity. Delinquency is picking up, so we're going to talk a lot about that today. And then how do we use this information to help with our profitability? We want to continue to be profitable as we go forward. So really diving in today on how not only can we understand ALM, but how can we use this to help with that strategic planning side of things. So we go into a little recap of our 101. Bill, why don't you tell us a little bit about what we covered and why?
Yeah, so for 101, we define what ALM is. We also tell you why and how we perform the analysis, which, we use a static balance sheet, the period end balance sheet, and rates. We primarily focus on net interest income and also net economic value. And we do rate shocks instantaneous, and we also do some non-parallel and gradual rate shocks with our analysis. So that's kind of a recap of what we do. And I think Heather's going to explain a little bit more detail on what that means.
Yeah, definitely the two high-level main focus concepts here. You're going to see Bill and I refer to this quite a bit as we go through today's session, is really focusing on that impact to our interest income and the impact to our value. Those are really the two main tests that we do when looking at interest rate risk. So when we look at the definition of ALM, ALM is an acronym. It's Asset Liability Management. And this is the art as I said, a little bit of science, a little bit of art. This is the art of managing that mix and volume of our interest sensitive products. And I always giggle. I'm Italian. I talk with my hands. I like pictures. I like those movements. And I love this little symbol here of this teeter-totter. And a lot of times when we're talking about ALM, it's really looking at that balance of both sides. So one side being our assets and our liabilities, but also looking as rates go up or as they go down, how does that sensitivity teeter between both directions, whether we're in a rising rate environment, a reducing rate environment. We've experienced a lot of that recently and talking about where we're going forward. But how does those asset and those liabilities complement each other and tip the scale as we go into both of those rate environments? Right now, we're in this higher rate environment and hoping for a little bit lower over time. And how does that move the needle, so to speak? So, Bill, there's a little bit of why and how we do this. We get the concept of, looking at that risk position. How do we usually go about this?
Well, one thing you always want to constantly assess your balance sheet mix in different interest rate environments. As you mentioned, we've been into some very extreme situations between rates and liquidity, right? A few years ago, we had too much liquidity and rates were real low, and now we don't have enough liquidity and rates are really high.
Yeah.
So, you always have, and then you have to look at that and how it impacts your balance sheet, right? So that mix is very important. The how is we do start with the current balance sheet, and we use a static balance sheet, right? So we'll talk about a growth balance sheet and budgeting also going forward, but from our regulatory perspective, this is what we start with. We also want to talk about simulations, which are real important because of these extremes that we have. We may have to show the extreme, or maybe we're already at the extreme and we want to show something that's more normalized. Also, the in between. So it can give us a range of things to look at, to simulate, see what we think may happen. Or even if we don't think it may happen, at least we have a range to see what that might look like if it did happen.
Yeah. You bring up such great points. One is this constant assessing of the balance sheet. Like you talked about, things change so fast. So we really want to keep an eye on what's happening. And as you mentioned, the static balance sheet, this is a great baseline as our starting point. And then really incorporating some of these real world situations to identify what happens to the risk in this actual environment versus this assumed nothing changing for a year. And as Bill had mentioned, really diving into simulations and what ifs, that's really going to be our focus point today. We know we have that foundation established on this no growth baseline. Well, let's layer in all the other elements that come into play in our market and see what that may look like for us. So, Bill, net interest income. I know this is one of the very first of the two most important concepts. What does this page show us and the structure of what this is?
Yeah, so what we're looking at here is looking at the net interest income and net interest expense and looking to see what our margin might be. And then we're shocking the balance sheet and we're looking over primarily a 12-month horizon. We also do 24 months, but our main focus is a 12-month, which is, the go forward from where we are at that period. And then we do a shock test under the various rate scenarios. We go up and down 4 and 500. We also do a gradual, so we do a 12-month horizon on our interest rate shocks in our reports. So it's very important to do these to get a feel for which the impact might be in the different rate environments because we know that rates have changed a lot over the last few years. Also, the level of repricing activity will depend on the assets and liabilities that we have, right? So if we have more fixed rate products, it's going to give us a different answer if we have more variable rate products. Also, the term or weighted average maturities on these products also have an impact on what the net interest income is going to look like.
Yeah. And it's a great tool of looking at income and how this may change as that market starts to change, especially as rates start to possibly drop as we're hoping for the future. So Bill had touched on net interest income, which is the first of the two main tests. And the second is value or net economic value of equity. There's two slides here, one for our assets and one for liabilities. And just kind of a quick overview. Back to that teeter-totter. Essentially, the longer your cash flow might be on an asset, like a 30-year mortgage, the more risk that may hold. So that teeter-totter is really going to tip downward, meaning that if our cash flow is going out 30 years and rates are going to increase, that likelihood of of loans going back in the books at that higher rate is probably going to slow down. So you're locked in at those lower interest rates in these up rate environments. We've experienced a lot of that right now as many people had refinanced their loans back in 21, 22 when rates were so low. And that is really adding a little extra Neve sensitivity as that market is so significantly higher than what we may have seen, where about 80% or so of those loans right now are just really not going anywhere. They're locked in at those low rates. Now, as we look at midterm and overnights, you're going to see that teeter-totter significantly more flat. That cash flow turns over very quickly. We're going to respond to what the market's doing. And that overnight funds, as you can see here, is essentially zero across the board. It moves in lockstep with the market. There's basically no sensitivity here. Whatever the market's offering, that's what we're earning. Now, as we go on to liabilities, this again is that counterintuitive side. The lower these numbers are, the less you're taking away from your assets, leaving you with a higher net economic value of equity or net equity position. So as we look at total assets and total liabilities, if our values are a smaller number, we're going to have more equity at the end of the day, having a higher position. So it is a little counterintuitive on this side. And we're going to talk a little bit today about some of those non-maturity deposits and how that duration may be impacting us as we're seeing some shifts of what's currently going on. So Bill, going into our 201, getting into the assumptions that go into it. Definitely a lot of moving pieces here.
Yeah, and this is definitely very important. So in 201, we did cover the model assumptions because the model assumptions impact the results so much in your risk profile and decision making. So it's very important to understand the assumptions that are going into the models. And these are some of the most important assumptions that we have and you should be aware of and just consider what you should do with them. So prepay speeds, prepay speeds, if mortgages are going to prepay faster or slower, depending on a rate environment. We're going to show you an example of that coming up. Maturity deposit retention also, right? So when we had all this inflows, the money was sitting there for a while, but when rates started rising, it started moving out. So we'll look at our retention rates and impact on that, and also the beta and rent sensitivity factors, which are the change in rates on our products in relation to the Fed and the market rates. Also important, we'll talk about this a little bit, is repricing and replacement rates. We're going to talk about how a lot of folks had promo accounts that are maturing here towards the end of the year in the first quarter of next year, what we might want to do those, and it all depends on your balance sheet and your market. So we'll discuss that a little bit later also. And the accurate assumptions equals accurate results. If you had bad assumptions, you're going to get bad results. So in computer technology, they used to say garbage in, garbage out. We want to have accurate assumptions as possible because it does impact our spread and margin and profitability, which we'll talk about some more also.
Yeah, it's definitely been very interesting seeing how fast things can change and making sure those assumptions are keeping up with what's currently going on. Prepay speeds have definitely been a piece that's swung very quick for us, and we got some good examples here.
Yeah, so what we have here is we're showing the Fannie Mae commitment rates, which as those went lower, prepay speeds picked up. And on the left-hand side, this is the 30-year, right? And then when the rates started going up, prepay speeds slowed down. And you can really see that impact, which we're showing you from 20 to 22. It's kind of leveled out in 22 and 23 because rates have stayed high. Right? They continued to go up and they've stayed high. So you can see the impact on a 15-year also. So basically, lower rates lead to faster speeds and higher rates lead to slower speeds. And so if you get slower speeds, you have extension usually on your products and extend out. If you have high prepay speeds, then they shorten up.
Yep. And it's definitely a big impact as, again, that teeter-totter, that lengthening of that cash flow is adding a little bit more risk. And we're seeing a lot of that in definitely different perspectives. So our next piece is the non-maturity deposit retention. This is a very important part when we look at Neve. Neve is focusing on the value of our balance sheet. When we look at non-maturity deposits, these are our only interest-bearing products in the balance sheet that don't have a contractual maturity date or call schedule, we're not sure how long these deposits are going to stay. So a lot of times we like to do studies to identify what those trends may look like. And again, this is focusing on non-maturities. So our non-interest-bearing deposits, checking accounts, savings accounts, IRA, money market, any of those liquid types of funds. And, we've been spending a lot of time doing a lot of core deposits recently. A lot of focus there, as we saw, as Bill had mentioned, when during the pandemic, we had lots of cash coming in the door, we had all the stimulus money. And now, because the economy is getting harder and harder and rates are so much higher, it's using a lot more of that liquidity and a lot more of those funds. So as we monitor and we look at that retention activity over time, what is going on with this activity and what does this tell us and how do we use it? So one example here is looking at the difference between rate shoppers and sticky deposits. So, and we're bringing this up because we're going to actually incorporate this into some of that decision making we want to use as we get ready for next year and understanding that risk position so we can plan for next year and understanding if you have any product types that Bill had mentioned during this time of squeeze from a liquidity standpoint, what product types were the ones that left the institution faster than other products? Are we pricing these appropriately? What does that activity look like? And when you see sticky products, those are usually more our cores, like checking accounts, savings accounts, things of that extent. As you can see, some nice steady retention in those core type products, unlike money markets that are inherently priced a little bit more aggressively, a little bit more market sensitive. You can see that activity really came down quite a bit during this last couple years. So we know that this product type for this balance sheet example shows that we really need to hone in and focus on some of these deposits that may not be with us as long, which may cause some liquidity concerns. We may have to review our pricing on those that impacts our bottom line and our risk position. So these are the types of things we want to look at, especially with deposits right now. This is a big focus point for us. So not just retention on deposits, but there's also our pricing that goes hand in hand with that and how we price all of our interest sensitive products. So Bill,
Yeah, and
tell
so
us a
with
little.
that, if we look at beta, if we look at the betas or rate sensitivity, we'll call them. So we have these on our products to say what is the response or the change in the rates to our products to 100 basis point move in the Fed funds and market rates. So we want to see how we respond, our products respond to those changes. It's very important. It has a big value impact, especially on non-maturity deposits, right? Because the less sensitive they are to those rate changes, the more value they provide to the institution.
Yeah.
And what that does is you pay below market rates a lot of times, whether it's for promotion accounts or brokered CDs or borrowing. So there's a lot of value if you don't have a lot of sensitivity to the changes in rates. The factors to consider are the product types. The different product types have different sensitivity factors, fixed and variable. Do they have any caps or floors? Or also periodic caps on anything. So the one thing we do like to talk about is when we do core deposit studies, and we kind of think those are very important now because we've had such a change in environment, right? Both from being flush with funds to having liquidity challenges. And we like to see what's going on there over time and see what that might look like. Because again, that gets back to the assumptions that we use, right? We want to make
Yeah.
sure we have accurate assumptions to get accurate results.
Yeah, I mean, it was interesting as you mentioned that focus on core deposits. What we've identified, and we see this a lot, is during the time of liquidity squeeze and trying to bring those deposits in, the assumption is we're going to put betas on non-maturities and we're going to move those deposit costs. Well, what we identified and a pattern we generally see is most of that focus is more on the term side than it is on the overnight side to control some of those expenses. So really evaluating how we responded in the last couple of years to those rate changes will really start to impact some of that risk position and kind of help offset some of those expenses that may be occurring. So, Bill, we definitely have some decisions to make and to look at, but there's a lot that's expected to occur here in the next little forward look that we can see what the FOMC is providing us. Definitely some things to be prepared for, correct?
Yeah, definitely. And we should get some indications in the next week or so when the Fed meets, right? So
Yeah.
they're meeting next week. They'll release their statement. I think Chairman Powell also has a press conference after. But if you look at the rates that we have here down at the bottom, the forecast right now is for a 25 basis point decrease from 550 to 525. Then what's interesting, you see a 50 basis point decline for November, then 25 again in December, and then January, 50 basis points again. So the market's showing 150 basis points from now to end of January. When we got a full year, it's forecasting 3% in September of 25, right? So that's 150 basis points. And we
Wow.
wanted to get this in a presentation to give you guys some context on what the forecast is looking like, right? We'll get a lot more clarity next week, we think, if depending what their statements say, but we'll definitely see what their decision is going to be. And they'll provide some clarity on what they're looking like going forward. So with this kind of gets the context on what we're trying to do to make our decisions and when you're doing your planning. But we'll have some more clarity next week after the Fed meeting.
Yep. It's definitely an important piece to take into consideration as we're looking at the trends of where does our profitability stand? How do we price our products? Where is our focus for that next year? Looking at those trends of spread and margin, we are in the margin business. We want to continue to be profitable and understand where those opportunities may lie. So monitoring our trends to see exactly where we've been, if our increasing costs is going up too quickly in comparison to what we're earning on our asset side, there's definitely some great opportunities that we're going to dive a little further into today on kind of where we can make up some of that just based off of what, Bill was just talking about with those Fed expectations going forward. So Bill, kind of a recap of our overview on our 101 and 201. A lot of this, we can kind of incorporate this right into this next step.
Yeah, exactly. So we did again mention accurate assumptions and results. I just gave you an example of what that might look like if it's not. We also want folks to, think about this. It's not a regulatory burden, ALM, right? It can be a valuable tool for decision making and risk management, right? So we're in
So I don't
the
need to take
business
this and throw it in a drawer for the examiners to come in.
and just pull it in and out, right? No, we want you to be
Very
more
useful.
proactive with that and not reactive, as we say here. Also, here at McQueen, we spent a lot of time, effort in putting online simulators online for you guys so you can do them 24/7, 365 days out the year to do what you think you might want to do, or just to, I want to say, run a variety of scenarios, extreme ranges. Your standard reports have quite a few scenarios in there, like we talked about gradual shocks, instantaneous shocks, and non-parallel shocks. But you also might want to change balances and product mix, and our simulators can help you do that. So I definitely would say, use the simulators that we have to help with this management and use it as a tool and not as just a regulatory document that you got to do every quarter. Use it as a tool because it can be very valuable, especially when we get into budget and planning season. And it's much better than a crystal ball because if we had a crystal ball, then we wouldn't need anything. We'd have all our answers that we needed all the time, but that's not the case. So use is very valuable too. We think it's very important to use.
Yeah. And I love the idea, like you mentioned, with that simulator. Examiners are really focusing more and more on not only testing this out, measuring it against our balance sheet to ensure it's the right decision. They're expecting any of that to happen before you pull the trigger on something. Say we decide to do a special
That's
here or a
right.
special there. They want to know, did you test your balance sheet? Did you show that you can do this? What is going to be the impact? Is this the right decision for us? It's become almost an expectation that I see with many examiners. So, this is a piece that's really valuable. So as we go into our 301, again, we're talking about budgeted season. We're leveraging our ALM to help make these decisions. And like we mentioned earlier, we're still focused on liquidity. There's some great opportunities here, as Bill had mentioned, with the turnover of some of these higher price term deposits, these are coming due. We've got some things to talk about. Also focusing on that lending side, but that goes hand in hand with that increase in delinquency and that impact of what our bottom line and that profitability. So looking at this first tab, as we mentioned a little bit earlier, looking at the activity that we are seeing on DK, non-maturity deposits is really causing a lot of that ongoing concern and focus of liquidity. It's not nearly as stressful as it was a year or so ago, but it's still relevant. It's still there. It's still something we need to talk about and plan for. So again, monitoring the trends that may be occurring if you have certain product types that have a little less retention, we want to start by addressing that. Once once we address that, could we have slowed this? Were we as active in pricing these relevant to keeping those dollars in the door, or was our focus more on that term deposit side? These are the items that we want to think through and say, did we do the right things? Are our assumptions appropriate? We see that we've got a big drop here. Should we reduce what these retention expectations are simply because this is more of a rate shopping product? These are the things that we want to look at and start with that first so that we understand where that need position is before we make the next layer of decisions. And using those historical trends of what has occurred, especially in this kind of rate cycle that we've been experiencing, that's your starting point. Again, making sure the assumptions are accurate, because I can't make proper decisions if my starting point is inaccurate. So really reevaluating what's been going on our balance sheet and understanding if we need to make any adjustments before we can really kind of jump into that next layer of decision making. So when looking at this piece here, so say we did reduce, just an example of if we reduce the term on our money markets because of that activity that happened, where does that take our NEIF position? So as a quick example, we shorten that a little bit. This is a product type that maybe doesn't have as much volume as our checking accounts or savings accounts. So that's good. That's going to be a little bit of a benefit to us. So with that being said, where does this take our NEIF position, and making sure that we're still within reason in regards to policy? So this example just shows that we're getting closer and closer to that policy limit. So what does that tell us? That tells us that that teeter-totter is it's pulling a little far in that up scenario. We may want to shorten that cash flow a little bit on our decisions, maybe not adding 30-year mortgages, instead maybe adding auto loans, something that's going to complement where our starting point is. So just making sure we're looking at those things before we really start diving into that planning to make sure our starting point of that conversation is appropriate. So Bill, we've talked a lot on the deposit side. Now, term deposits, we had some really heavy activity in the last year or so. Now is kind of the time to kind of take in that futures, look at where rates are going and how we're kind of pricing and looking at that deposit on. It looks like we definitely have some great opportunities here.
Yeah, the thing, as you mentioned, we did have, big inflows in term deposits, right? Because there was an outflow in a lot of non-mature deposits, primarily because of rates. So our clients and industry started pricing up and creating these promotion accounts and term deposits. And with that, the cost of funds were going up, and you're seeing two things. Hopefully, we're attracting new money in there, but we also seen some movement from the non-maturity deposits, the low rates, into these term deposits. And I think rightfully so, a lot of folks may have priced up maybe more than they wanted to make sure they had the liquidity as insurance. And I think that's very important. It's better to have the excess liquidity than not have it at all. So people may have paid up for the deposits and rate. Now that those maturities and promo accounts are coming due and maturing or repricing, now is an opportunity to see what your liquidity position is now and going forward. We're talking about budgeting season. What do you see for your loan growth next year, right? Or what do you want it to be? So with that in mind, and what your competitive marketplace is, what type of products do you think you need to manage that growth, right? And we're talking about, we wanted to show you the Fed funds forecast, so you see what that looks like over the next 12 months. And with that, may have an impact on rates, but also on your loan and deposit volume, right? So if you do have these maturities coming up, do you have more liquidity now where you don't have to price as aggressive, or your marketplace isn't as aggressive, or maybe you do and it is more aggressive, right? So you may have to balance that, but you also have to look at what the cost of borrowings might be, right? So if the borrowings are cheaper, you may want to do those. They're more expensive, you may want to avoid them. We're seeing right now they're still more expensive than the certificates and deposits that we're seeing, but it is an option. And we're going to show you what those options are here in the next slide or so. But definitely be thinking about this, because a lot of these term deposits are coming due and maturing. So you're going to have to reprice those. But also, we just talked about that money market account also, right? So if rates are coming down, you might be able to back off on those rates also. Again, it all depends on your particular institution's balance sheet and competitive market, and then your strategy. What is your strategy going forward?
Yeah. And I love that you've got these kind of numbers here looking at maybe the deposit rate examples of what we may see versus a borrowing equivalent. Knowing and understanding your market and how you need to price, that may be a big driver on the decision making on which way to go. So that
Yeah,
definitely
definitely.
leads into
Mhm.
loans and lending that kind of goes hand in hand with that deposit on. It seems like even though things are tight right now, there's still some opportunities in some lending. So Bill, it looks like we have a few kind of focus points that we see on a lot of balance sheets right now. Tell us a little bit about these and kind of some of the obstacles that go hand in hand with some of the lending that's going on currently.
Yeah, so we definitely seen a lot of demand for unsecured loans when that's just signature loans and credit card loans. Auto loans are still doing fairly well, and actually you pick up home equity because no one really wants to refinance those first mortgages at those low rates that you mentioned, right?
Right.
But we do think that's an opportunity going forward because, and we also suggest fixed home equity fixed loans versus HELOCs, right? Because if rates are coming down, we want to lock in those fixed rate loans if we can. We also mentioned auto loans because as Heather mentioned, if you do have the runoff in deposits that some are, then you may have to shorten up because you're not going to have the retention term as long, right? You also may have higher betas, which means more sensitivity also. Unsecured is higher rates. We have to be conscious of that also with delinquencies picking up. So definitely manage your credit. So if you're going to do unsecured loans, you're going to get the higher rate, but definitely manage your credit because we are seeing, pickup in delinquencies and losses. And next, the pricing. So, we want to make sure you're pricing your loans appropriately for the risk involved. So we'll talk about that also, is that making sure you have the right pricing in place at the right product in a right rate and economic environment that we're in.
And you bring up such good points because when we look at these trends and making sure we're pricing appropriately, understanding some of the delinquency trends that we've experienced, especially as we're running CECL. Not only are we looking at a longer historical look back period, but we can really identify the activity that we're seeing, especially this year. We've seen a lot of pickup there. So as that's happening, we have some great tools that are available to us. So as we get into those, we want to make sure that we are bringing in all of the current activity of that product type that's going on. So as Bill had mentioned, we've got this, kind of build up method we have available through our navigator where you can go in and you can pick and isolate these product types and do this structure where we can kind of bring in all of these moving pieces together to make sure that we are pricing these loans appropriately to take in all this consideration. So when we look at our risk-free treasury rate, which is somewhere around a 3 3/4 right now, really looking at our CECL allowance, incorporating what that delinquency expectation is. We have to build that into those rates so that we can really control that increase that we're experiencing. Obviously, we've got some credit tier spreads that go on that will vary depending on the credit level of which you're looking at booking. There's some servicing costs that goes hand in hand with that. And then what is our desired ROA or ROE? This is going to help drive some of that pricing structures we want to do, but really focusing on that delinquency side as we price these. This is probably one of the most important pieces that we're seeing a material change of right now. So as that's occurring, making sure we're monitoring that. So
Yeah,
Bill
it's a great
is,
point, Heather. And also to use it on your simulator. We do have the
yeah.
loan pricing module on a simulator so that our clients can go online and make the changes they feel necessary and come up with that loan build up on the pricing.
Yeah, it's nice. It's a nice tool to kind of quickly bring those values together for you. So lots of information, lots of things to discuss, and this can be a little bit overwhelming. So, kind of recapping some of the things that we've talked about, what do we know based off of what we've discussed so far?
Yeah, so we're going to go through a few of the issues that we just talked about in a little bit more detail here. So we talked about money market deposits are decaying faster than they were before. So what might we have to do? In our assumptions in a model, we may have to reduce our retention term, right? Because they're not going to stay around as long as they have before because we have seen this runoff of the non-maturity deposits. The other impact from that, it's usually less favorable NAV sensitivity because our liabilities are shortened. And if nothing else changes, then we're going to have a more sensitive balance sheet because our liabilities shorten and our assets haven't. So what do we suggest? Look at shorter term lending. Look at shorter term products that you might have and see what those look like versus 30-year fix. And you're going to see the 30-year fix, you're going to have prepayment risk there. But if you do have some shorter term lending to offset this, increase sensitivity from the shorter non-mature deposits, that's what you might want to look at. We also were talking about these promo deposits that are maturing. This is definitely something I've been talking to clients about on the calls, that do you need to continue these promotions? Or did your liquidity position improve enough where you can go back to your standard rates? And I'm seeing different answers and solutions to this with different clients, right? So again, it's going to depend on your balance sheet, your mix, your strategy. Also, should you borrow, right? If borrowings come down quicker and it makes sense to do that, and you can get the term that you need quicker and it fills in the bucket that you need on your liability side, then that's something you should look at also. And so we're looking at this and what's the best way to fund loans. So look at these three options when you're going through your strategies sessions coming up here with the budgeting and see what works best for you. The other thing we're talking about, though, is we are seeing delinquencies pick up. Most of what we're seeing is in the unsecured and credit cards, but also we are seeing delinquency in some other products also. So what you want to do, you want to have then your rates reflecting that. We talked about that CECL factor and coming up the build-up rate, right? So look at what your CECL factor is, your delinquencies are looking at, and factor that into your loan pricing. And I say that against all products that you have. So look at all your loan products that you have. We're talking about maybe focusing on auto loans and higher quality credit auto loans. Delinquencies for auto loans have risen also. So you want to factor that into your auto pricing, and the lower tier credits are experiencing higher delinquencies versus a top tier credit. So take that in consideration also. But if your deposits are coming in shorter, right, you're going to have some shorter term loans to match that off.
Yeah. Yeah, there's definitely different ways that we can approach this. And these are some great examples of some of the themes that you want to look at, take into consideration, and utilize to kind of implement. So, Bill, we've got a great setup here, kind of going right into the themes that you just brought up. And we have kind of what we know. Now, how do we use this information? It looks like we've got a few different great options on some of the things that we can test and see what that impact looks like. Looks like we have a few different options, and then we have to make a decision on, where do we want to start? So tell us a little bit about, you mentioned a lot about the promotional deposits. We know we had some great opportunities and rates are going in a direction that we hope will continue to drop. Looks like we have some different things that we kind of want to test and look at.
Yeah, so what we're talking about here is that we have those three options that we mentioned, borrowings, promotion accounts, or standard accounts. We laid out those three there. For this purpose, example, we went with the middle of the road, the promotion accounts, saying we still may have to continue those in this environment. And to do that, what that might look like. But if we in another situation, and again, each situation for each credit union is different, they may not have the ability to generate the deposits that they need, and they may have to borrow some, or they may have to roll over their borrowings. That's really what I see more of anything, is rolling over borrowings that they currently have, but that still might be a little bit more expensive than promo accounts that they have. But if you don't have that liquidity problem, and I do see clients with this, they're able to reduce their rates and get back more into standard pricing. So when you do this, when the simulation that Heather and the team ran, you can see in the current position there, it actually improves profitability some, right? And also in the down rate environments, it's still positive, right? So we're looking at a down rate environment. When we look at the sensitivity in the other ones, we do see that it is in the up rate a little bit less and a little bit more in the down rate. But overall, there's not a lot of sensitivity in doing this.
Yeah.
And what we both based this on was 1% asset growth.
Yeah. Yeah, we want to just start with a simple example. And we know that we maybe have some extra sensitivity in that down scenario and knowing the market is changing. Know that this is the starting point of how you want to layer these decisions together. This is a static balance sheet output. So using this information to start and then deciding from there, how do we protect ourselves as rates go up and down? Bill, I love the fact that we used almost a duration match between both sides. You had mentioned earlier, and we had talked about how non-maturity is maybe shortening, and that's going to add some need sensitivity. When you do this duration match at both sides, you stay very, very stable. And that's really going to help complement when you have some of these high risk positions we want to monitor and check. But really looking at not just that up scenario, but also looking at the down scenario, and then really starting to layer in some of those additional things that may protect us and keep us very profitable, even if and when the market starts to drop a little bit. But at least as a starting point, we're starting at a higher position, still making, even though we may come down a little bit more, you can still see that profitability is still higher than what we started even in a down 200 scenario. So definitely a lot of great things that we can use and, test as we start to look at that. So Bill, we want to look at that impact to net interest income and NEV, depending on the activity that we're doing as well. What are the things that we want to look for here?
Well, here we start with the net interest income test that we have here. And what you see is kind of what you were just mentioning. We don't see a lot of change in sensitivity overall. It's a little bit less in the rising rates and about flat to a little bit less in the down rates. So again, that's good. We don't have much sensitivity in this simulation. When we look at the market value of equity, you can see we're not having a whole bunch of sensitivity here either, right? So in both the NAV and the NII, sensitivity is minimum, right? So we don't have a lot of sensitivity and we can pick up a little bit of net interest income. The other thing we'd say is you can run some variety of scenarios on that and change the rate or change the mix and see which you can maximize to an extent you can do it and see what the best income and net EV results look like for your institution. So that's what I suggest, take a look at it for you guys' own institutions, see what looks best for you based on volume and rates, and then take that into consideration in your strategy going forward.
Yeah. And that's the great part with the simulator. You can play around with this in every which possible direction. So, this is definitely things that we want to be able to play around with and, kind of layer together. And we can go to extremes and test that out and see where that takes us. That's kind of the fun part of this exercise is kind of starting and layering those things together. We have lots of different opportunities, and profitability is always our focus point of things. So we talked a lot about our loans and our investments and our deposits and those focus points of things. So when we look at those items, that's everything that's tied to interest rates. So we know we can control those parts as best as we can using this information, these tools to do so. There's definitely some other opportunities that we can look at because not only are we looking at that interest side, we're looking at the whole balance sheet. So Bill, there's definitely more layers to this that we can talk about, we can bring into that conversation. What are the things, kind of, how do we want to approach that? And what are some of the things we want to look at?
Yeah, so in profitability, there's probably a few things to look at now. If you go to the next slide, we'll have that. But what we just talked about, was that enough, right? So we can do things with the pricing on both the assets and liabilities, try to improve that spread and margin. And is that enough for us to get us where we need to do? If we don't, the other thing we have is some examples here, but as we mentioned, with delinquencies higher, you have to think about higher pricing on loans maybe than you in a normal environment to offset those delinquencies and losses that you're having, right? So definitely look at the loan pricing that you have to make sure you have it set appropriately for these higher delinquencies and losses that we're seeing. Also, if rates, continue to go down, and they have come down, right? You may start seeing more refinance activity. We're not necessarily expecting a boom because, as Heather mentioned, so many folks have rates, in the threes or lower, some in twos, threes and fours, but they're definitely lower than where they currently are, right? So there's not a lot of incentive for people to refinance into a higher rate unless they have to. So what does that provide for us as institutions? Maybe generate some more fixed rate loans, sell them to the agencies or sell them to participations, get some fee income, maybe get a gain on sale, and then book some servicing income also. So this is more of a mortgage banking activity, but generate these loans and sell them for the fee income that you can generate from. Also, we're talking about, insurance. If you potentially have the opportunity to sell insurance, I know as consumers, we're all feeling the impact of higher premiums, auto rates, home rates are going through the roof. The ones we're seeing, I think in the latest CPI number that came out, 16% increase in insurance for autos, maybe
Wow.
20%. I know in housing, it's even more. I know where we are in California, they're up 30 to 50% a year. Also, I know it's impacting folks in Texas, Florida, and I think nationwide. I think Michigan also, rates are up everywhere with insurance. So if the premiums are going up, then the commissions go up and your fee income goes up. So that's something to think about, and people need it. So if you guys are lending on it, you want to make sure they have insurance. So if you have the opportunity to do that also. And then the last two we're want to talk about is employee benefit pre-funding accounts and the charitable donation accounts. Now, these are some really good opportunities to put some money to work. The other thing is we talked about maybe shorten the balance sheet on the asset side to, compensate for the shortening of the non-maturity deposits we have. Well, with these two accounts, you can extend that duration out on the asset side, right? So on the investment side, you might be able to put more of this money to work in high rates for a longer period of times and stay away from callables or negative convexity type products like mortgages. So we think this is something definitely to look into that also can be beneficial in a falling rate environment and also offset benefit costs and also help on your charitable donations. So these are two benefits that we think you should look into also. And what we're going to tell you here in a little bit, that's what our next webinar is going to be on. So we think, just for this to let you know about that, and then you're going to get a lot more details in our next webinar. We think it will be very helpful going into budgeting season.
Yeah. And it's great pieces to consider and look at. Some institutions may already have some of these things on our balance sheet, and some may not. This may be things that we may want to look at and really take into consideration. I'm actually going to jump ahead just a second. There was some Q&A that came through, and one of them is talking about these non-interest sensitive things and how to incorporate this into a model. It's a great question in regards to how do we capture changes of non-interest income or expense values. This is an important thing to look at as those expenses or income can vary depending on a rate environment. So, we know that when we look at loans, investments, and deposits, those are impacted by the movement of rates in the market. The non-interest side is as well. A great example is the selling of mortgages. As you brought up this as a possible option on that gain on sale, how does that look from an income and expense standpoint when we are paying lenders to bring these on the books and how that volume changes with the market? As rates go up, it's harder to bring those loans on. That incentive is lower. And as rates start to drop, you're going to expect to see that expectation and that demand to go up. These are things that we want to capture on that non-interest side as well. And the great part with our navigator is you have the ability to actually put in dynamic non-interest income and expense values. And I think that's important when we look at things such as sale of products or the activity that you see when it comes to fee driven opportunities. And then you also have the other side of things like value, say on the MSR side of things. There's so many layers to this that you can really incorporate and look at, and some great opportunities to take into consideration, especially in these markets. And Bill, I love the fact that you brought up this down scenario and protecting yourself in that situation. As we know that incentive to refinance will pick up as rates go down, how do we keep us protected as we're going to put some of these products back on from an asset standpoint at a lower rate? So these are some of those fantastic opportunities that we may want to take into consideration. All right, so going on to the next piece here, just kind of recapping, a lot of things that we talked about today. How is liquidity stress impacting our balance sheet? This may have softened for us over time, but it's definitely something that is a topic of conversation we still want to be looking at and monitoring. And as Bill had mentioned, some great opportunities on that term side as we're seeing that rollover continue to happen. And then understanding our NEAF position, as we know those deposits really kind of impact where that can be. And then planning on the impact from the profitability standpoint. We got lots of opportunities and lots of different ways we can go about this, and then utilizing all of this, to make sure that profit margin still is very strong. Again, we don't want to take this model, throw it in a drawer and be done with it. We want to make sure that we're using this information, helping make decisions, using the tools that are there. There's lots of great ones that kind of come in that we want to make sure that we're utilizing all of those moving parts and really testing what this could look like. So Bill, any final thoughts on our educational series for asset liability management?
I think my final thoughts would be, we did see what the Fed implied forecast is with rates and rates coming down. It looks like, there's a high probability of rates being changed at this meeting next week. It's a matter of how much. We are in a budgeting planning season, so I would take that into consideration as you go forward with your budgets. As we have been talking about, these maturities and repricing that's coming on a lot of these promo accounts on the liability side. What can we do with those? Do we need to continue to offer high rates to maintain it? Do we not? Do we borrow? I think these are all good questions as you're going into your strategic planning and budgeting process to look at. And keep an eye on the markets of what's going on. So I would watch and see what happens with the Fed next week. You'll be getting calls from Queen advisors about that, and we will be putting out an email about that. So definitely be taking this into consideration as you go into your strategic planning and budgeting sessions here in the next several months.
Yeah. So, Bill, actually going hand in hand with that exact topic, we had another question come in that asked how we can better gauge how much we can afford to pay for our deposits. The premise being that we could probably afford to pay more for those deposits than we might like to believe. So, with that being said, you definitely hit on taking into consideration all these other parts and looking at your pricing. Is there any additional things to take into consideration when determining what you can afford to do?
I think again, it gets back to your individual balance sheet and what your asset mix looks like, and what are those opportunities out there. So, for example, if you have strong loan demand, then you're going to probably have to pay up to continue to keep those deposits. Or let's say your marketplace, they have competitors out there that have rates much higher. If you don't need it, then you can potentially reduce your rates off of those promo rates, and also look at where you're going to be investing that money if you have the excess liquidity. So it's kind of a balance in that, getting back to that teeter totter, right? How much can your particular market uh, demand for rates to keep those deposits there? How much do you need those deposits to fund your balance sheet and growth? I mean, so let's say if you're growing 1%, that's a different assumption and need than if you're growing 5 and 10%,
Yeah.
right? So again, each individual situation is different. So what I would probably do is, look at your plan and what you're trying to do as far as your growth and loans, and forecast from there. How are you going to fund that growth? And look on your maturities that are coming up over the next several months, where those rates now, where the rates in the marketplace, and where you think you can offer them to maintain them, right? Because usually your clients are going to look and say, okay, I got this rate here. What's the market right now that I can go get in the marketplace? And how close are you to that? If you're pretty close, it's probably not going to move. But if you're far off the market in rates, then it may move. And
Yeah.
the other thing is, you guys probably know what promo account, especially let's say if it's a CD promo, which ones to be concerned about. Those are most likely to move versus your core, your members that have been around a long time. So take that in consideration when you're going in and you're pricing it. And that's what I'm saying. You may have to keep a promo account out there with a rate, or you may not, depending on your situation.
Yes. Yeah, and such fantastic points. And just to layer a little one more kind of comment on that, really look at your down scenarios. We're expecting rates to come
Mhm.
down a little bit. So really looking at the structure of what your balance sheet looks like from a cash flow standpoint. And when we start to go down, if that's where we're expecting the market to go, make sure your timing of when that turnover of those lower rates going on from the asset side isn't going to outpace the expense that may happen on the deposit side, depending on how long these deposits will go on for, depending on the term of the specials that you want to focus on. So definitely some lots of great tools that you can play around with to really test out where that threshold is for you so you can determine what's at appropriate pricing.
Yeah, one other thing I would say is, let's say you had a 12 or 13, 15, 16 month almost CD. You may want to I would suggest shorten that up quite a bit because, rates are coming down as the Fed forecast is showing, right? So if you're locking in at a higher rate now and rates continue to go down, then, it's not going to be as beneficial as being able to reset those rates lower going forward. So again,
Yeah.
look at that rate forecast we have in our economic updates we do with you guys. It's in that report all the time at the last page. So I keep an eye on that also.
Yep. Great, great information. Thank you so much, Bill, for joining me. Love the topic. Definitely a big focus point this time of year. So thank you everybody for joining us. And we did get through your questions. Any additional questions that you may have, please send that our way or to your advisor. We're definitely here to help you through any of those items. And getting ready for our next webinar, as we had touched on at the end of ours, today is really talking about the EBPA and CDA. There's some really great opportunities to offset what we can do, to kind of protect ourselves in this possibly down rate scenario environment. So we definitely want to hopefully you're able to join us. That's going to be September 25th at 2 o'clock. And again, thank you for joining us today. We will have this has been recorded. This is going to be available on our YouTube channel, and any questions along the way, please don't hesitate to reach out. Bill, thanks again for joining today, and thanks to
Thank
everybody
you.
else. And we hope to speak with you soon.